Hey, good afternoon. We've got a lot to cover with retail sales updates, a continued focus on jobs and jobless claims here today. And we are really stepping into the heart of earnings season as we kick off for this quarter. So a lot to touch on. Of course, a big focus on, not just the consumer, but also on jobs and what that means for interest rates and all the above coming up. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, hopefully weed out a bit of the noise along the way. And we've got a lot coming up here. I think, what we've seen is the markets have been pretty stagnant. We're going to talk a little bit about that here for our question of the week. But it's because I think there's so much on the horizon. Before we talk about what is coming, let's take a step back and look at what happened last week. So Friday last week, we had retail sales numbers come out, and retail sales were actually down 1%. Not a huge drop, but it is a little bit below expectations. And I think more importantly, what I got out of some data I've been looking into lately was something I've been talking about for some time here now. What we have been through, obviously, over the last, 15 months or so is a period of pretty high inflation. Pretty high, very high inflation, right? And what I have kind of shared every time we touch on retail sales is that although that number has been up, the reality is that inflation kind of drives that to some degree as well. So the question I've kind of been proposing is, well, is that retail sales number really because the consumer is spending more, or is it because the costs of goods that the consumer is buying are costing more? And what I have officially found to support that theory is that in reality, what is happening is when adjusted for inflation, retail sales are actually basically flat in the US through this period. So I thought that was really interesting. Again, I've touched on it quite a bit before, but now we can kind of share it as more of a reality. This is not necessarily a bad thing. It doesn't mean anything bad for the consumer. It also doesn't mean anything good, right? Unfortunately, when you look at this retail sales number on the surface, over the last 15 months, you might say, okay, well, the consumer is extremely strong, which I would not argue, but the consumer is extremely strong. They're spending even more than they were, pre all the economic challenges we're facing. But in reality, when you strip out inflation, now we can say that that's not actually the case. In fact, they may be spending the same. Now, obviously, it costs them more, but they're not actually buying any more goods or services, right? So I think that's really important to kind of keep in mind. Again, this isn't a negative thing. It doesn't mean the consumer is going backwards. It just means that maybe they're not spending as much as the surface level data would suggest. Continuing on the consumer, we also had consumer sentiment numbers come out Friday. It was a little bit of a tick up from last month and a little higher than expected. So this was interesting to see. I think my take is that it's probably a lot around speculation around the Fed and what's going on with interest rates. But, reading into the consumer sentiment number is obviously very, very difficult. But nonetheless, consumer sentiment was a little higher than last month. The other leg to this stool is jobs, right? I think really the three legs are, consumer, jobs, and inflation. So the other leg to this stool is, of course, jobs. Jobless claims numbers came out today on Thursday, and we're slightly up again very slightly up, I should say, at 245,000. So this is important because jobs is becoming a big factor. It's one of the areas that the Fed has felt they could keep pushing on because the discrepancy between job openings and jobs being filled was so big. What we saw last month was maybe a slight crack in the jobs market. Over the last 3 weeks, we have seen jobless claims continue to increase. So will that be kind of a sign of another crack in the jobs market coming up next month? Obviously, time will tell, but nonetheless, you can bet the Fed is watching this and factoring this into some of their decisions, or maybe not their decision, but at least the language of what they're watching ahead. All right. Separately, we are really getting into the heat of earnings. So this week we had earnings around Netflix came out, Prologis came out. There were a few bigger companies that reported earnings. And really, I think that this will tie into our question of the week. And I don't want to touch on that too much quite yet because I want to share, before we get into wrapping things up with our question of the week, I want to touch on what is coming next week. Next week is going to be a big week in the market because we have all the big tech earnings, Microsoft, Google, Amazon, Facebook, right? All those guys. But we also have housing data and we have Q1 GDP first read, right? So those are all going to be extremely important as we look into next week. Now, to back up a little bit and talk about our question of the week, which is all about what is going on with the markets lately, the short answer is basically nothing. I mean, if you look over the last 2 weeks or so, the markets have been very, very quiet, not a lot of movement going on, which has felt like a sigh of relief, to say the least, after what we've been through the last 15 months. But the question is, well, why? What is happening? What's next? I have a hard time answering the what's next part of it, but I will suggest that in the next week or two, we'll really start to dictate where we go from here. The reason I share that is next week, again, we've got big tech earnings. So I think the market is just kind of taking a break as we wait to see how some of these giant companies that make up these indexes are looking at things, not only for the past quarter, but also how they are maybe adjusting or not expectations for the year ahead. So that's going to be really important. Again, we have started earnings season, but next week is the big one with some of the largest names, some of the names that make up the largest parts of the index all reporting next week. Second, housing data, I wouldn't put too much, salt into that, I guess. It is important, don't get me wrong, but I think more importantly is that we also get the Q1 GDP read. And so we will wait to see what that looks like. But, I think the market is paying very close attention to these data points, seeing if there's maybe some cracks in the GDP that may suggest this recession we've been talking about for a long time here, but also seeing what these giant tech companies that, again, really make up the indexes that we follow, every day, are going to suggest as far as looking backwards and forwards. All that on top of the Fed coming up early May, which obviously is the big factor. It's funny, the earnings used to be, that was like the thing to watch. That actually determined how these companies were growing and how we might invest. Not to say it's not important, but it certainly seems like that has taken a back seat, and all of the focus is on the Fed. So obviously we are still watching that as well, but I do expect some movement one way or the other next week as we gear up and get some of this big tech earnings data to come out. So thank you guys all for joining me here today. We will see you next Thursday. Definitely tune in Thursday at 3, where we will probably have some sort of guidance as far as where the market goes from here, at least for the short run, and break apart some of the GDP numbers and big tech earnings.